A diversified ETF portfolio offers numerous advantages. However, there are also pitfalls that could potentially cost you thousands of dollars. Here are 7 mistakes you should avoid when investing, especially in ETFs. Let's start with mistake number 1, lacking an investment strategy. Before investing in ETFs, it's crucial to define your goals clearly. Are you aiming to secure long-term retirement savings, or do you prefer regular dividend payouts that provide additional disposable income today? As ETFs can vary significantly in their characteristics, your objectives and strategy should be established from the beginning. For instance, some ETFs reinvest dividends received from underlying companies, leading to increased value and compound interest due to accumulated earnings. Since no dividends are distributed, there is no additional taxable income, postponing tax payments. Hence, this approach is well suited for long-term investments, as it enhances the compounding effect. On the other hand, an ETF with dividend payouts provides immediate access to the money, allowing investors to use them for further investments or expenses. Mistake number 2, ignoring tax strategies. In the US and many other countries, specific tax regulations apply to capital gains related to the sale of ETFs. These regulations distinguish between capital gains from short-term and long-term investments. Short-term capital gains resulting from ETF sales are usually subject to the investor's individual income tax rate. On the other hand, long-term capital gains typically enjoy lower tax rates. To classify a capital gain as long-term, the investor must hold the ETF shares for at least 1 year and 1 day. If the holding period is less than 1 year, the gains are considered short-term. If you want to realize your gains in a tax-efficient manner, it is crucial to avoid falling short of the 1-year holding period. In the previous video, we learned that index funds and ETFs are quite similar, with the distinction that ETFs can be traded on the stock exchange like individual stocks. This brings us to mistake number 3, impulsive trading. The ability to trade ETFs at any time can be a significant disadvantage, as it may tempt investors to make spontaneous trades within their portfolio. While ETFs are passive investment products widely used by many investors, some may actively trade them to make sector or country bets. However, if your investment strategy involves building a passive portfolio that is extensively diversified and globally invested in stocks, then actively trading ETFs isn't advisable. In other words, you should refrain from buying and selling them in the short term, especially if you have a long-term investment approach. Instead, following the buy and hold strategy, you should purchase ETFs with the intention of holding them for the long term. Let's explore mistake number 4, ETF hopping. It's essential to avoid frequently moving your funds from one ETF to another or constantly switching the ETFs you invest in through a savings plan, whether on a yearly or more frequent basis. Why do some investors engage in this behavior? There are various reasons behind it. For instance, there might be temporary ETF promotions offered by online brokers, allowing investors to invest in specific ETFs through a savings plan for free during a certain period. However, these promotions are purely marketing tactics and are usually time-limited. After some time, they may be discontinued, or new ETFs might replace those on the promotional list. Additionally, new ETFs might enter the market, offering more cost-effective options or better alignment with your investment strategy. Moreover, changes in tax regulations or mergers between ETFs providers can lead to the dissolution or merging of certain ETFs. The ETF market is highly dynamic, presenting several reasons for investors to reconsider their investment decisions regularly. However, it's crucial not to abandon your investment strategy in response to such external events and hastily construct an entirely new portfolio or invest in entirely new ETFs. For instance, in recent years, the market has seen the introduction of new ETFs and index funds that offer more attractive features than their predecessors. The ETF market's rapid growth results in intense competition among providers, prompting them to continuously enhance and make their products more appealing. Therefore, if you initiated a savings plan on a specific ETF 10 years ago, it might be worth considering halting that plan now and starting a new one that could be more cost-effective or tax-efficient, better suiting your investment preferences. However, before making any decisions, careful calculations should be conducted to assess the value of selling the old ETF shares and purchasing new ones. These calculations should consider tax implications as well. Keep in mind that older ETFs are often upgraded. For example, if they have become relatively more expensive due to general market developments, providers might reduce management fees to maintain competitiveness. Hence, it's essential not to be swayed solely by brokerage offers. Regularly switching to new ETFs can lead to unnecessary complexity in your portfolio and generate additional costs. Mistake number 5 is investing in financial products you don't understand. This applies not only to ETFs, but also to all other financial instruments. As we mentioned earlier, the industry is thriving, continuously introducing new and innovative ETFs focused on specific sectors or utilizing unique algorithms. However, it's essential to avoid blindly investing in a biotechnology ETF without a clear comprehension of what biotechnology actually is. Investing in sector-specific or country-specific ETFs that exclusively represent particular industries or geographic regions, such as an ETF tracking the American economy, means taking a sector bet that is closer to an active investment approach. The same principle applies if you intend to create a factor portfolio. Factor investing can be done passively by investing in factors that promise higher returns, but it also requires the willingness to accept somewhat higher risks. There's nothing wrong with building a straightforward portfolio consisting of just two ETFs, like an ETF tracking the MSCI World and another for the MSCI Emerging Markets. However, if you seek an additional return boost by adding a factor ETF to your portfolio, understanding the subject thoroughly becomes critical. By doing so, you can prevent panicking during market downturns, even if the factor ETF temporarily exhibits negative performance. Mistake number 6 is falling for the diversification illusion or product overlap in individual ETFs within your portfolio. While this may initially sound complex, it's actually quite simple to grasp. The key is to avoid having the same company included in multiple ETFs within your investment portfolio. An ETF is essentially an investment fund that holds a diverse range of stocks from different companies. However, if you combine, for example, an MSCI World ETF with an ETF tracking the S&P 500, you may encounter overlaps in their holdings, including companies like Microsoft, Apple, or Amazon. As a result, you inadvertently end up with an overweight position in these specific companies, since they appear in both indices and, consequently, in both ETFs. It's vital to be aware of the companies present in each index, especially when pursuing a strategy that aims to avoid overlapping geographical zones. That said, intentionally emphasizing such an overweight might be justifiable in certain cases. For instance, some investors might think the 60% US exposure in the MSCI World is too high and intentionally include a European index to increase their exposure to European markets. Nonetheless, it's important to be mindful that product overlaps can undermine your diversification efforts, leading to an unintended concentration of specific companies that appear in multiple indices and ETFs within your portfolio. Let's now delve into mistake number 7, which involves becoming overly obsessed with costs. The good news is that private investors have become much more cost-conscious when it comes to investing in recent years. In the past, there were financial products with exorbitant costs that generated substantial profits for intermediaries, but their returns failed to compensate for these high expenses. Even with most actively managed funds, costs can pose a significant disadvantage. It's not uncommon for the hidden ongoing costs of such funds to reach up to 3% annually. To counterbalance these costs and achieve satisfactory returns, one must aim for a decent yield. In an ideal scenario, active funds should outperform the index. Otherwise, investing in a passive product would have sufficed. However, when it comes to ETFs, we are dealing with truly cost-effective financial products. Generally, ETFs offer well-known indices with a total expense ratio of around 0.1% per year. Nevertheless, it's crucial to consider not only the prices, but also other criteria, such as tax aspects or personal preferences, when investing in ETFs. For instance, do you prefer a distributing or an accumulating fund? ETFs are already inherently designed to be cost-effective financial products. It does make sense to compare the total expense ratios, which represent management costs, as well as the tracking error, which measures the difference between the index's performance and that of the ETF. However, it's important not to become overly fixated on these aspects and avoid switching ETFs solely based on slightly cheaper options. Instead, thoroughly assess other characteristics of the ETFs to determine whether a particular one aligns well with your investment preferences. Now, if you want to learn more about the different types of funds and the stock market, I recommend one of these videos. Anyway, thanks for watching. Please like and subscribe.